Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Wednesday expert and actually longest running expert, Anna Kelly. Hi, Anna.
And favorite expert, Michael.
And
you forgot to say that this time.
My favorite expert.
Thanks.
So, hey, I don't know if you saw this, but wow, we're on January 5th and rates are already running. We talked about where rates might be, right? We gave some guesses for the end of the year, but they've moved a lot in 7 days or whatever it's been. So I'm guessing I want to talk about what rates are doing if people aren't paying attention. And then more specifically, I think rising rates is going to create pain and it might not be where people expect it. So I thought we should talk about that.
Absolutely. I mean, we've been talking for quite a while that the Fed's going to raise rates and rates are going to go up. But what a lot of people don't realize is that the consumer rates that we pay, either as a primary home or on investment properties, they're not directly tied to the Fed rate. So our rates can go up even if the Fed rate doesn't budge. And that's exactly what just happened. So, I made an offer on a property on the 3rd and the rates were one rate. And by the 5th, they've gone up a quarter point, right? Well, why is that? Because the banks in large are expecting that the Fed is now going to raise rates in the next 2 months. And because they're anticipating that, they want to get ahead of that. And they went ahead and, most rates rose a quarter of a point overnight.
Yeah. And again, the rising rates is going to be the theme of the year. And it's going to be interesting because we've essentially had 40 years of declining rates, right? Ever since Paul Volcker beat inflation by taking rates up to 18 or whatever it was, we've had 40 years of declining rates. I think it's fair to say that the next several years will be a rising rate environment. Not a lot of us have done it. You and I haven't. We've been doing this 20 some odd years. We were part of that 40-year decline, right? My first loan, I think it was 7 3/8, and the last one I got was 3.99. So again, I benefited from that as well. But rising rates are going to hurt, and I don't know if people really appreciate it yet. So let's talk about where people could probably see the pain.
Yeah, I mean they're definitely going to hurt investors because we have rising prices and rising rates at the same time. So for now, until property values start coming down, our profitability goes down when rates increase, right? So this property that I was looking at that we talked about in the first 2 videos, about a quarter point rate change on about a $360,000 loan was about $40 a month. So it's not substantial, right? But it's still, it made like a 0.2% return difference, right? But that's a small loan. Right. Now, once you get to bigger loans, what happens though is your debt to income ratio, that debt service ratio starts teetering. And so in order to maintain the the net income level on the property to cover the new higher mortgage payment, you've got to drive down the price or put more money down so that your loan can be the same as what it was before rates started going down.
Yeah. So I think there's a couple of things when I think about owner occs that I would point out. First and foremost, a rising rate environment, generally speaking, as long as it's slow and not a hockey stick up, will actually pull demand off the sidelines in the short term, right? Mom and dad have been waiting. They missed the bottom. They're like, oh my God, rates are running. I'm going to buy now before they go up later. So one of the things you're likely going to see if you're a real estate agent is you probably will have some buyers who are on the fence get off the fence. But the following on that is you'll probably have a gap in your pipeline, right? Where because again, what happens is rising prices, rising rates, affordability goes down, less people can get a yes answer from a bank. So I think if you're an agent, you probably will see a short-term, people getting off the fence, but you're going to have to work harder here. Where you're going to see the immediate pain, and I called this 90 days ago, is the big box online mortgage brokers who have been feasting on refis are about to starve, right? I saw a scary statistic. I think Matt, the mortgage guy, brought it to me last Wednesday or maybe 2 Wednesdays ago. 68% of mortgages have been recast in the last 2 years.
Wow.
So that means there's only, 30%. And by the way, some of those don't have mortgages. So it's probably like 20%. It's just not enough pie left. And you're going to see some job losses, some shrinking or whatever you want to call it in the mortgage industry. And also, if I was a consumer, I would be hypersensitive because there's a lot of bad big box online folks that are not good people, right? They're salespeople that are going to get boiler room like and just high pressure. So, that's the first thing I think that happens in this environment. What do you think?
Yeah, I think it really from a mortgage rate perspective and mortgage loan originators and layoffs, I haven't really thought about that until you just brought it up, to be honest with you. When I think of where demand is going to be, I still think rates are still so historically low that in most markets, Michael, where you're undersupplied, the demand's not going to change much.
It'll go from 2x to 1.8x the supply. So it doesn't matter because you only have X. Yeah.
Right. So I think, sellers are still selling and buyers are still buying. I think the refis, to your point, start coming down as people start to go, maybe they already had a 4.25, and now they're still going to get a 4.25. They're going to let it go. And I actually know somebody that's actually just happened to. The rates went up and it wasn't enough of a difference for them to refi. So I think that refi definitely starts to teeter off. But I think in markets where there's still continual growth and limited supply, I don't think a quarter point's going to make that much different in the housing demand, or especially in the investment property demand. Now, once you go up, half a point, 1%, I think 1% starts to kind of, cause some pullback in demand if inflation starts to decrease. If the 1% rate increase doesn't make a big dip in inflation, I think investors are still going all in to beat inflation, even if rates are 5.
Yeah. Ooh, wow. Oh, I couldn't imagine. So I think so today, Mortgage Brokers Association reported the average 30-year rate's 3.33. It's up half a point in a year. So again, right, we hit the bottom sub 3.
Yeah.
Yeah. If we go from 3.3 to 5 this year, that's going to, again, mortgage brokers, that business is about to be hard because the refi business is done, right? You're not feasting anymore. I think if rates go to 5, real estate agents slow down. I think 5%. Again, it's so funny. People want to scream rising rates, housing crash. That's not how it works, folks.
Right.
What may happen is we may have a crash in transactions, right? Because this is what nobody talks about is we've had 40 years of declining rates. You got into a home 2 years ago. You're up 20%, but you have a 2.875 mortgage.
Right.
You now got a raise. You're doing this, that, the other thing. You have money, and you normally would be a move up buyer.
Right.
The last 20 years, you went to a bigger house. You had a lower rate. Your payment was marginally different.
Right.
Now you go to a bigger house with a higher rate. It's going to be huge. So what people will do now is they will upgrade where they are.
Right. Instead of moving. I agree with you. And one thing I should clarify too, when I'm saying 5, an investor property loan today is about 4, right? Exactly. Because investor property loans are always 0.75% to 1% higher than what it is for a consumer that's buying their primary home. So where I'm saying as an investor, yesterday rates were at 4.5 on a 30-year fixed, 4.2 to 4.5 on a 30-year fixed, non-Fannie Mae huge multifamily loan. So best execution, 850 credit score, 4.25 to 4.5, 30-year fixed on investment. Already they've gone up to 4.5 to 4.75. So when I say 5, I mean, it's not that much further up, to get there. But I think 1% bump for consumers total from where we were before yesterday, I think definitely starts to slow things down on the higher end homes. But I think as investors, it doesn't make much of a difference to me. I'm still buying.
Oh, believe me, one of the things I've been hoping for is a housing slowdown. So I will be uber aggressive because a housing slowdown is actually good for me. Because again, I have my buy box. I know my market. I know all these things. I welcome a slowdown. I don't like having to make, I honestly don't like having to make a decision in 7 minutes. I don't like it. Right. It's not my preferred method. Right. I'd rather have 7 days to think about it.
And to your point, being a mostly single family home investor, you want prices to come down. And the good thing is for single family homes, it's usually either an owner-occ or it's a smaller investor. Now, of course, we see big investors buying a bunch of single family homes, right?
Crazy.
But if prices come down, comparable to the rates, and an increase of rates will slow down single family to some extent, you're probably not going to be in a much different position with a slowdown in a higher rate than you are with a higher price and a lower rate today.
Yeah, just do the math. It's people want to talk about price like it's directly correlated. It's payment, folks. Again, I did the math, I think, I don't know, a year ago. And it's like, hey, if rates go up a point, my property falls 5%, I'm behind. So I should buy now, right? I should pay more now because the rate was better.
Right.
again,
And to your other point, the 50 years of research that you did, which was incredible, every 5 years, let's look at real affordability based on incomes, interest rates, and prices. And we know incomes are going through the roof. We're having a big increase because of inflation, because of people leaving the labor force voluntarily. Wages are going up. And so even if rates go up, your income is still going to make that affordable. And if rates go up, prices come down a little bit, and your income goes up, then you can still be very profitable. So, I hope listeners don't go, oh no, we've missed the boat on real estate. Like, there's always a good time to buy. And you just always want to look at, depending on where rates are at the time, your down payment, the income that it'll generate, what's the cash on cash, and what's the total return. And if they're still good, they meet your criteria, buy the property.
Excuse me. It's always a great day to buy a great deal.
Absolutely.
The other thing I want to highlight is that 50 years of research, right? People don't realize, they talk about rates go up 1%, pricing has to fall 10%, like it's written in the Bible or something. Folks, we had a decade where rates went up 300 basis points, which means, to your logic, prices should fall 30%.
Right.
Folks, the fact are rates went up 300 basis points and property values went up 88%. So put that in your pipe and smoke it.
Exactly. Yeah, because, the past can show us things, but what happens is people think of the past and what they heard in the media. They're not looking at, the data that we looked at, right? And so when you look at the actual data, the numbers really don't lie. Real estate investing, is generally speaking, the thing that creates the most millionaires over anything else. It's consistent, it's proven. Values go up, not down in most markets. Yes, we've had, you have 2007, you have certain pockets where there's a tech bubble or whatnot, but across the United States, real estate is a constantly upward moving venture and proposition. And as long as you're buying in growth markets, values are going to keep going up, even if interest rates go up.
Yeah, I couldn't agree more. So Anna, this has been a lot of fun today. Look forward to hearing about your growing portfolio down there in Florida. Where can people find you?
Great. You can find me here every week on our playlist, One Rental at a Time. You can find me on social media, Anna Kelly, REI Mom, on Facebook, LinkedIn, and Instagram. My websites are reimom.com. And if you're interested in passive investing in apartments, greaterpurposecapital.com.
Very cool. Thank you very much, Anna.
Thank you, Michael.